I've got the top 3 tips when buying a multi-unit property right after this. Hey there, my name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates, and we're going to start with interest rates. So we saw a slight increase in rates, which honestly is a lot better than previous weeks where we saw large increases in terms of the average 30-year fix. So check out the link below to the average 30-year fixed according to Freddie Mac this week, and this is kind of mid into late October, is at 6.94%. While you're down there checking out that link, click that like button, hit that subscribe, and click that bell icon to be notified as I'm putting out weekly videos on the channel. Now, where are interest rates going to go moving forward? So I can see a use case for rates moving up, maybe even a full 1% from here, if and only if we see more data that says inflation's not handled, it's higher than previous months. If we start to see some of that information, I think we have potentially not hit that peak yet. Now, if I was a betting man, I am, 60-70%, I would be on the, hey, we're likely at basically our high for the kind of current quarter or times. Like, I don't see a lot of use case for it going considerably higher if that inflation number doesn't come in as high as we've seen. And I've made videos previously, which I'll link to. But with that said, let's dive into this week's topic, and that's the top 3 tips when buying an investment property, a multi-unit, whatever you want to call it. But basically, if you're looking at a 2, 3, or 4 unit property, potentially living one, potentially not. But these are the top 3 tips. So first and foremost, 3.5% down if you're going to occupy one of the units, right? So you can take advantage of FHA financing. You obviously have to apply to get credit qualified, but a lot of times people think, hey, if I want to buy a multi-unit, I have to have a large percentage down. So misconception number 1, tip number 1, you can do it with very, very little down payment, obviously 3.5% down. So you want to check with your loan officer on kind of the max loan amounts, the max purchase price, what that might look like with the FHA financing. There's pros and cons, but lower down payment is definitely an option. So one of the things that I want to make sure and relate to you, if you're made it this far in the video, is just occupying a home and taking advantage of these low down payment and leveraging, that low down payment so you can do it again later, potentially then buy a single family home, for your family, and then still own that 2-unit property, gain equity as someone else is paying you rent back, right? Like, these are awesome ways and tools to be able to kind of help build wealth over time through that. So tip number 2, and that is leverage equity potentially in your current home. Now, this would be more if you're going to look at being an investor and invest in, say, a multi-unit or an investment property, is use your primary home, which typically has all the tax advantages possible. Every year tax policy changes, so depending on when you're watching this. But with that said, use the equity in your current home. If you've built up equity in a lot in 2020 and 2021 into 2022, we've seen really big increases in equity, for primary homes. So, look at something like that. If you own a primary home and want to buy an investment property, you don't want to live in it, true investment, in this case, then this is an opportunity where you could, if you own a current home, to maybe pull some cash out, do a line of credit, do something. I understand rates are higher, but this is the time to at least do the math of what that might look like, because a lot of times you're able to get a property now in Q4 of 2022 for under asking price. So you potentially might be able to find a very good deal with someone that needs to sell urgently and be able to make that into an investment property. Say it's a 2-unit, and be able to have somebody paying that mortgage and be cash flow positive on that. So, and then tip number 3 is, don't think it's not possible, is that projected rental income, or an appraiser will go out and say market rent for this unit would be X and for this other unit would be Y, can be used, or at least a percentage of it used, to qualify for a mortgage. So let's say you're going to bring in $1,000 a month in unit 1 and $1,000 in unit 2. Well, that's $2,000 to offset. Now, likely a lender's only going to be use a percentage of that, say 75%. Now, a lender could offset that payment by $1,500 that you're bringing in. So if the mortgage payment's only $1,500, there's no additional debt that a lender's potentially qualifying you on. A lot of times people, I don't know if I'm going to be able to afford it, but I think it would be a cool idea if I'd be able to do this. I've saved up this money. I've seen somebody else do this. And then once we actually get into the numbers and look at what they could qualify for, again, as a lender, it's my job to be able to look at them and say, straight in the eyes and say, okay, if this place was vacant, do you feel comfortable making that mortgage payment, right? Making sure we're setting them up for success. But tip number 3, and a lot of times that misconception is, it's not possible. I'm not able to do it. But most times when you look at what the projected rental income is and you look at the program, you're likely going to be able to, find a reality of what could work for you. So this is the Mortgage Minute. My name is Ryan Skaggs. If you've made it this far in the video, hit that subscribe button. I would be forever grateful. Stay safe. Put your comments below. I'd love to hear what next topics you want covered, and we'll see each other again very, very soon.